The VIX is commonly referred to as the fear index, but this label obscures a more nuanced reality. Implied volatility is not a direct measure of collective dread, rather, it is a price determined by market makers to cover their hedging costs and inventory risk. Wall Street often labels the VIX as the fear gauge, and when it spikes, headlines scream panic. However, academic literature presents a different perspective. Implied volatility is not a pure expectation of future turbulence, it is a price that reflects the costs and risks borne by intermediaries who quote options. These intermediaries, known as market makers, must manage their inventory and hedge their positions, and these activities influence the prices they set. To truly understand the VIX, we must examine the market microstructure, the mechanics of how options are traded and priced, rather than relying on the collective mood. This approach reveals that the VIX is a product of market dynamics, including hedging demand and risk management, not just a barometer of fear. By shifting our focus from psychology to mechanics, we gain a more accurate understanding of what the VIX actually measures. Market makers play a crucial role in the options market, standing ready to buy and sell options while earning the bid-ask spread. However, they are not passive participants. When they sell an option, they take on risk, and to neutralize that risk, they engage in delta hedging, buying or selling the underlying asset in proportion to the option's delta. This hedging process is not costless, it involves transaction costs and requires capital. These costs must be recovered, and thus the price of an option, and consequently its implied volatility, must compensate the market maker for these expenses. The market maker's role is essential for liquidity, but it also introduces a pricing component that reflects the costs of risk management. Therefore, the VIX, which is derived from option prices, inherently includes these hedging costs, making it a price rather than a pure measure of fear. The delta of an option measures how much its price changes for a 1-point move in the underlying asset. For example, if a call option has a delta of 0.5, its price will increase by 50 cents for every $1 increase in the underlying. A market maker who sells a call with a delta of 0.5 will buy 0.5 units of the underlying per option to stay delta neutral. This is the core of delta hedging, the hedge ratio equals the option's delta. However, maintaining this hedge is not static, it requires constant rebalancing as the underlying price moves and delta changes. This dynamic process involves frequent trading, which incurs costs. These costs are part of the market maker's overall expenses and must be factored into the option's price. Thus, the implied volatility embedded in option prices reflects not only expectations of future volatility but also the costs of maintaining a delta-neutral position. Delta is not constant, it changes as the underlying asset moves, and this variability is known as gamma risk. A market maker who is short options is short gamma, meaning they must buy when the market falls and sell when it rises, which can amplify price moves. This forced trading can lead to losses, so the market maker must be compensated for taking on this risk. Additionally, they face Vega risk, which is the sensitivity of option prices to changes in implied volatility itself. Both gamma and Vega risks are inherent in options market making, and the implied volatility quoted by market makers includes a premium for bearing these exposures. This premium is part of the volatility risk premium, which is the difference between implied and realized volatility. Understanding these risks helps explain why the VIX is not just a forecast of future volatility but also a reflection of the costs and risks that market makers bear. The implied volatility in an option price is not solely an expectation of future volatility, it includes a premium for the risks that market makers bear. This is often referred to as the volatility risk premium. The formula can be expressed as, implied volatility equals expected volatility plus a risk premium. The premium compensates for hedging costs, inventory risk, and the possibility of large, unexpected moves. This premium is not constant. It varies with market conditions and demand for options. When demand for protection is high, the premium tends to widen, pushing implied volatility above expected volatility. This is a key reason why the VIX often exceeds subsequent realized volatility. By recognizing this premium, we can better understand that the VIX is a price that reflects risk compensation, not just a measure of fear. In a 2009 paper, Gârleanu, Pedersen, and Poteshman demonstrated that demand pressure in the options market is a primary driver of implied volatility. When investors want to buy puts for protection, market makers must sell them. To hedge their exposure, they buy the underlying asset, but this also increases their inventory risk. To compensate for this additional risk, they raise the implied volatility they quote. This is not about fear, it is about the basic economics of supply and demand for options. The demand pressure theory explains that the VIX can spike even without a change in expected volatility, simply because of an imbalance in order flow. This insight shifts our understanding from a psychological interpretation to a market microstructure perspective, highlighting the mechanical forces that shape option prices. The fear narrative suggests that a VIX spike indicates investors are scared, while the pricing narrative argues that it reflects market makers adjusting prices to account for hedging costs and inventory risk. These two perspectives are not mutually exclusive, but they have different implications. Fear is a psychological state, whereas pricing is a mechanical response to order flow. Understanding the difference is crucial for correctly interpreting VIX moves. For instance, a spike driven by genuine fear might be accompanied by a broad sell-off, while a spike due to demand pressure might occur even in a stable market. By recognizing the pricing mechanism, we can avoid overreacting to VIX movements and instead analyze the underlying market dynamics. This nuanced view allows for more informed trading and risk management decisions. The demand pressure model formalizes how order flow affects option prices. The key equation is that the option price equals its fundamental value plus a term that depends on the net demand from end users and the market maker's risk aversion. This additional term is the demand pressure premium. It shows that even if expected volatility remains unchanged, a surge in put buying can push implied volatility higher. This is because market makers, when faced with high demand for puts, must increase the price to compensate for the risk they take on. The model provides a quantitative framework for understanding how supply and demand imbalances impact the VIX. It underscores that the VIX is not just a reflection of market sentiment but also a function of the options market structure and the behavior of market participants. As of mid-August 2026, the VIX stands at 14.25, down about 24% over the past month. This level is well below its 60-day average of 17.02. The current low reading suggests that demand pressure is low, and market makers are not pricing in much hedging risk. However, it is important to remember that a low VIX can also reflect complacency, which itself is a risk factor. When the VIX is low, investors may become overconfident and take on excessive risk, potentially leading to sharp corrections. Therefore, while the current VIX level indicates calm market conditions, it should not be interpreted as a guarantee of stability. Monitoring the VIX in the context of market conditions and demand dynamics is essential for risk assessment. If you understand that the VIX is a pricing output, you can use it more effectively in your trading decisions. A VIX spike might be a signal of hedging demand, not necessarily a forecast of future volatility. This distinction can create opportunities. For example, if a spike is due to temporary demand pressure, selling volatility might be profitable, as the premium is likely to revert. However, beware, demand pressure can persist, and the risk premium can widen, leading to prolonged elevated VIX levels. Therefore, it is crucial to analyze the underlying causes of VIX movements rather than reacting to the level alone. By incorporating this understanding, traders can better time their entries and exits, manage risk, and potentially capitalize on mispricings in the options market. In conclusion, the VIX is not a fear gauge, it is a price. A price that reflects the costs and risks of market making, driven by the demand for options. Next time you see a VIX spike, ask yourself, is the market scared, or are market makers simply repricing their inventory risk? The answer to this question changes how you trade. Understanding the true nature of the VIX can help you navigate the markets with greater clarity and confidence, avoiding the pitfalls of the fear narrative and focusing on the underlying mechanics that drive volatility pricing. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.